Hey folks, Dan Frio here with your market open on November 21st, 2025. So I hope you guys missed me yesterday. But what happened yesterday? We kind of called it. Here's what I was saying. Remember I said something about the employment numbers? I said, I don't think they're going to be all that bad, but we could have the unemployment rate tick up just a little bit. And that's exactly what happened yesterday. So mortgage rates didn't move, but we're going to go over that data. That's basically what crumbled the stock market yesterday. But we're going to recap what happened yesterday. There's really no economic news today. And the reason why I'm doing this, folks, is I want you to understand what the heck is going on with those and the whys behind it. And the reason why I do this, folks, I'm actually a federally licensed mortgage loan officer. I mean, I'm licensed in all 50 states as well as Puerto Rico. If you need some help, if they're looking to buy or refinance, I'd love to help you. We have a slogan. It's one application, one credit pool. We're going to compare your loan to over 30 different lenders. How do we do that? I'll tell you at the end of this video because you're here for these things. So let's get to it. So here's what happened, here's what's happening today. Fed likely to not cut rates in December following delays in the September data. But the data that came out yesterday, well, let's get over to it. Here's what I want to recap for you guys. Here's what we've called so far this year. I said the housing market isn't going to crash. You're going to see maybe a little bit of gains in the markets. We're seeing exactly that. I think we see the housing market, if you're looking at existing homes or new homes, they'll be between 1 and 2% increase in prices. So we hit that. Then I said in Q4 of this year, we're going to be at a rate about 5.99 to 6.375. We're right there. Okay, so now the other day I was like, okay, you got to watch these numbers. You have to watch these numbers because I don't think the jobs reports are going to be as dismal as a lot of people are saying. And they weren't. There's a whole slew of numbers here, and I'm not exactly sure what's up there. But you can at least see over here, they were expecting in the 200,000 range, and we got in the 200,000 range. Average hourly earnings, that was a little disappointing at 0.2. But here's the jobless claims, 220,000. Last reading was 228. The participation rate went up, and I think that's what caused the unemployment rate to go from 4.3 to 4.4. So that's what actually sparked the market yesterday morning, and we had a nice little rally in rates. And then all of a sudden, stocks took a turn, bonds took a turn, everything took a turn, and here's what we got over here. But here's what started the day. Let's get back over to the jobs report, because it's kind of a little confusing, especially if you go over to this right through here. There's all kind of numbers here, but what we called was the jobs report isn't going to be as bad as the markets actually think it is. So was that going to be good news or bad news? Well, let's get back to Rick Santelli yesterday. Let's look at the news that he gave us, and then I'm going to show you the market reactions and then why we had pullback. Then I'm going to have a live event today as well, folks. So if you're out there, you want to recap what happened this week, stocks, bonds, cryptocurrency, and real estate, join me today at 1 o'clock, and I'll go over this week and what I'm thinking is going to happen next week. But let's go to Rick Santelli, see what he had to say about the jobs report numbers, how it wasn't as bad as a lot of markets thought. And then if you could see down through here, it says 4.06. This yesterday was much higher. So let's get over to Rick. I'll put all this together after he speaks because I'm going to come back and explain to you guys what the heck's happening with these and the whys behind it. So Rick, take it away for me, friend.
Away from that delayed jobs number. We're watching the futures this morning. They're up sharply ahead of that because of what we heard from NVIDIA last night. Dow futures up by about 250 points. S&P futures up by over 80. The NASDAQ now indicated up by about 425 points. Take a look at what's been happening in the Treasury market. We have seen higher yields. The 10-year sitting right at 415.
So let's pay attention to this. If you don't have access to my channel, if you do, subscribe over there. But if you don't have access to it, look or follow the 10-year Treasury. See up there yesterday, it was 4.15. If you look down at the bottom of the screen down through here, it's 4.06. It's a pretty substantial move. I want you to pay attention. Remember, this was from yesterday. Then we come back. I'll bring you up to date on where we are today. So keep going, Becky.
The 2-year at 361 ahead of all of this. Rick Santelli is standing by at the CME in Chicago. And Rick, these numbers are much delayed, but still, it's data, and we will take what we can get, right?
Yes, and there's gaps. From the last data point to today's data point, there's lots of weeks missing in claims. There's months missing in all the other data points. And here we go. This is the September jobs report. Non-farm payrolls are up a robust 119,000. 119,000 will be the best since April when we were up 158,000. In the rearview mirror, well, last month was downgraded from 22,000 to minus 4,000. Now, if we look at what's going on with the unemployment rate, it ticked up from 4.3 to 4.4. That was unexpected. 4.4 would... last time we were at that level, boy, I have to go back a ways. October of 2021 when it was 4.5%. Now, if we look at labor force participation rate, it ticked up. That's a good thing. 62.4 equals where we were in May. You have to go to April of this year when it was 62.6 to find a higher number. In terms of the earnings, average hourly earnings, month over month, up 0.2. That's a bit on the weak side. We're expecting up 0.3. Up 0.2 equals where we were in June. To find a lower number, you are going in the Wayback Machine to August of 23 when it was up 0.1. Take a year-over-year perspective. This gets better. From 3.7, our last look and expectation, to 3.8. 3.8 would be the best since July when it was 3.9 because these have...
So what he just said there was income. The average person's income went up 3.8%. That exceeds inflation. Now, that's not going to get you rich, but at least you're going past the inflation number. So that, I just want to interrupt Rick for that. Get back to Rick.
Been trending lower. The high water mark, though, for the year is 3.9, and we've had 4 months of that. The first 3 of the year were 3.9%. If we look at the hours worked, and this is always important, it remains at 34.2. To find a lower number, you're going to January when it was 34.1. And finally, we get U6, the underemployment rate. It was 8.1 our last look. It comes in at 8%. 8% would equal where we were in February. To find a higher number, you're going all the way back to October of 2021. Now, we have initial jobless claims. This is for the week of November 15th. As I said, there's weeks missing. We're expecting 227,000. Comes in at 220,000. These numbers do not reflect nervousness in the labor market. They've been very well behaved. 220,000 would be the lowest level of claims since mid-July. And finally, on continuing claims, it ramped up just a bit, 1,974,000, and that would be the highest level since November of 2021. We see that interest rates had gyrated a bit, but after the dust settles, they're coming in at 4.11, which is a bit lower than a 4.14-ish we were hovering at. The pre-opening equities certainly don't mind these numbers. They're moving higher. We're up 371 in Dow futures. And what I find interesting is these numbers are pretty good. They're not off the charts good. They're pretty good. The unemployment rate ticking up, though, that may fuel percentages and probabilities for that ease. However, it may not be appropriate to ease considering the puzzle pieces missing. Those are the words of the Federal Reserve with respect to yesterday's guidelines and the minutes to the last meeting. Back to the gang, and I don't know, it certainly seems as though the market is really holding up well in equities.
So you got to remember that was yesterday. So let's get over to where the markets are today. So here's what we're seeing in the bond market. It just opened up and bonds are up. 30-year bond, or the MBSs, are up 7 ticks. That means mortgage rates could get a little bit better, but it's not a big enough move to really do anything. We need the bond market to move a little bit higher to bring rates down. So if you're new to the channel, what I follow here is the mortgage bond. This is a bond that trades on Wall Street. If you watch this bond, the yield on this thing is the biggest component of your actual mortgage rate, not the 10-year Treasury. So if you don't have access to my channel, you can subscribe over there. Make sure you check the 10-year Treasury because it has basically, it goes in the same direction on where the mortgage bond is going as well. Okay, so now let's get over to this. The stock market, here we go again. It's doing it again. But let me recap some things for you. So here's what happened. Going into this number, we're like, okay, I thought the jobs report number was going to be pretty good. I said, here would be a Cinderella story. If we can have the jobs report coming in pretty good, but have the unemployment rate tick up a little bit, because there is substantial amounts of weakening in the jobs market. That's exactly what happened yesterday. That really started the markets moving pretty good, that and NVIDIA earnings, and then it came around. It's like, okay, is the AI bubble here? What's the Fed going to do? What's this going to happen? And then the markets gave it all back. But we have hope in the horizon. Check out the headlines right across the board. That's what's actually moving the bond market right now. We have one Fed official that spoke today, and you'll see it flash across there in a second. He's saying, well, maybe there is room for a Federal Reserve cut in December. So Fed Williams revived December rate cut hopes, and that's what's actually moving the markets today. So that's just a Fed official. Let's get over and recap the data that we saw yesterday. Here's what happened. So the jobs market, it was pretty darn good, but the unemployment rate went up a little bit as I expected, and so that's what happened. If you go over now to the CME Fed Watch Group, this is what I focus in on each day. And we've done it since the Federal Reserve met last time, because when the Federal Reserve met last time, there was a 95% probability that they were going to cut again this year. Well, December's the last meeting. So in 19 days is the final meeting of the Federal Reserve this year. What are they going to do? Drum roll, please. And now they're saying the federal funds rate is a 65% chance it's going to be 3.5 to 3.75. Well, what is it today? Well, let's get over to the CME Fed Watch tool and see the economy at a glance. So this is where the Federal Reserve, basically they look at and they control. Here's what I mean. Over there is the federal funds rate that they control. See, it's 3.75 to 4. There's a range. There's a quarter percent range in this. They look at inflation, they look at the jobs reports, and they got all this data. So this, I don't think they're going to get any more official data until the day before the next Fed meeting. So they're saying right now the federal funds rate is 3.75 to 4. Well, the actual number right now is, well, they're expecting is 3.5 to 3.75. So now today there's a 64% chance of a rate cut. What do I expect? I don't think they're going to do anything. And here's why. You look at the jobs market that we just went over, it's pretty good. It's not dismal. Then you look at inflation, it's really not moved at all. So the Fed's sitting there thinking, okay, inflation hasn't moved. The job market isn't really a big concern now. That was our concern last time, because that's really why we cut. So this time I'm saying they're not going to cut. They're going to push till the January meeting. Then at that time, they're going to have a slew of data. They're going to have a bunch of reports on the economy. They're going to have reports on the unemployment rate. They're officially going to get, hopefully, maybe some resolution from the federal Supreme Court on tariffs. What am I talking about there? Well, if you haven't watched my channel, tariffs might be deemed illegal. We might have to refund this money back. That could be terrible. So that's what we're really focusing on, the next catalyst to really move the market. So if you're out there, you're a homeowner right now, and you're like, okay, can I refinance? Does it make sense to refinance? Let's get over to my channel. Let me show you what I do for a living, folks. My name is Dan Frio. I'm actually a licensed mortgage loan officer in all 50 states as well as Puerto Rico. So if you're a homeowner right now and you're like, okay, Dan, I can't track these rates. They're up, down. Every time I try to call and get pre-qualified, I miss it. What can I do? What should I do? Should I refinance now or what? Just put your information right in there. It's a RateWatch 2.0. It's a new tool we created. Put in your mortgage information in there. Let me know what rate you want to talk about refinancing. What will happen is we'll call you. We'll go over the numbers. We'll say, okay, here's what your new payment is, what your old payment is, your costs, your savings, your break-even point. If it makes sense, we'll lock you in. If not, we'll just wait till rates go a little bit lower. So that's what I do here on my channel. So if you're a home buyer right now, what I'm going to start doing is giving you a lock or float analysis, and then talk to those out there that are looking to buy, maybe in the spring, or looking to build. So let's recap this. Let's go to the front of this. Here's my thoughts. Okay, so what we're going to get is we're probably going to see some weakness. We might see another uptick in inflation. Yeah, because as the tariffs take a bigger bite of our economy, you might see inflation jump up just a little bit more. I think the jobs market will be stable to So there's no reason for the Federal Reserve to cut. So we're going to see mortgage rates stay steady. I'm saying they're going to stay steady through Q4, like I expected. And I'm not, at this point, going to change my expectations for Q1 of next year. And those are, I'm still going to say in my range of rates of 5.99 to 6.375. Now, we're at the top end of my range right over there. So I'm expecting it to not really go much further. Could it go to 6.5? Yeah. But we're going to stay in a tight range. So if you're looking to buy in the spring, I don't think you're going to have any problems, or you're looking to build, but reach out to us. Here's what we can do for you. At the rate update right through here, what you could do is schedule a consultation, and you put in your application, even ask me a question. But we want to make sure you can budget for it. You might have those grand gestures of, here's what I want to get approved for, and I can afford it. Maybe you can't, or maybe you can. Which program is best for you? What's your credit scores? Well, that really means what program you're going to fit into. You might not know this. You probably don't know this. That's where we come into play. Just getting you into the right program can save you thousands of dollars. Checking out our rate programs, like what we call our rate comparison. We have one application, one credit pool. We're going to compare your loan to over 30 different lenders. This is what we do for our clients. So once we get you approved, I have access to over 30 different lenders. We can use their rates and their programs. So reach out to us. We would love to help you. A little confused? I get it. So reach out to us so we can clarify this. It's not a hard sale, folks, when you call us. We're just walking through some questions with you and trying to help navigate you down the right direction. If you find some quality in us, hopefully you use us. So that's our report for this morning. I don't think rates are really going to change all that much. We have the MBSs right now. They are up 5 ticks. We got the Dow Jones, the S&P, and the NASDAQ all up. That's a Cinderella story so far. Oil's down below $60 a barrel. Folks, this is going to help inflation more than you think. Oil is in everything. Think how you got to work today, or how you got to the grocery store, or how you did this, your phone, your cups, your computer. Everything has oil in it. So as oil comes down, you're also going to see inflation come down. So we love that number. So that's it for today. What I'm expecting is mortgage rates to be flat all the way through the end of the day, but we will be live today, and I'm going to basically recap the week, recap what's going on with stocks, bonds, cryptocurrencies, and these things over here. And then I'm going to give you the news that's coming out next week and how those alone will be affecting these and the whys behind it. So thanks for watching. Hope you join me today at 1 o'clock on our live event. If not, make sure you subscribe down there so every time I post a video, you get an alert. Thanks for watching. Happy Friday, and I'll see you soon. Bye-bye.